Here I am, broadcasting live from sunny Southend-on-Sea. It's always sunny here. I mean, if you've been here, you know that's the truth. And there's a beautiful picture I found online of a Victorian postcard, and that's how they advertise Southend when the Victorians would come here and visit all the time. So there you go. So where are you calling in from today? Let me know. We've got the whole of the UK covered today. What have we got? Where are you listening in from? So Teresa's in Shrewsbury, Min in West London. We've got also Deep in Heathrow, Simon in beautiful Epsom. Jeff is in Northampton. Justin is in Clitheroe in the Ribble Valley, in rainy Clitheroe. Jonathan, you're living in Wimbledon today. Dennis in Norfolk. Colin in windy Eastbourne. Viral in Harrow. Adam McCarthy in the God's country. So I guess you're talking about your native Wales, of course. Robert, you are in not so sunny South Bucks. Good morning, Robert, again. We've got South West London from Robert Fortes. So we've got a good mix of people, good mix of locations as well, and even one Welshman. Isn't that great? And just as we talk, Craig Jardine logs in. Good morning, Craig. And Craig is from Scotland. So there we go. Got a good range of people on today, which is awesome. Right, so I'm going to do a bit on just some news and some updates for you on a few things I want to share with you. One of the most important bits of news that really is something that a lot of people have been asking me about recently is to do with the Novation. And as I talk, good morning to you, Stephen Mars, as well, as you log in as well. Good morning. Novation is we've got a big Novation to do from In Partnership to New Distribution from the old IPW business, and bearing in mind there's 3,000 or so policies in that transfer. I've been personally handling the whole thing myself without any help, as well as getting all the files in partnership as well at the same time. So I do apologise if I have been slightly slower on that, but it's just something I have to do amongst every other duty. But I am now making very good headway in this. I'm over 60% completed, so I'm in the back half now, in the back nine, so to speak, and they are coming in thick and fast. And I've been really working on it last week or so to get it all done. So we've got a few big ones over now as well, which is good, and we are starting to see a lot of business coming through. So don't be surprised if you start getting some renewals and so on. And especially the IFA trails renewals, which will come through every month. I also have asked In Partnership to provide me with a list of the monies they're holding for us, and I'm happy to say they sent me a very good breakdown actually, so I've got that to hand as well. I know exactly what they've got for everyone. So if you do want to ask, then there's no harm in giving me an email, calling me up. If you want to know what is in that pot, then I can let you know. Of course, they won't pay us that money until this Novation is completed, and also they've now picked up another 15 files they want. So again, I mean, I don't know where these files keep coming from. They need, but unfortunately, I thought I'd done it, and then they came up with another 15 we need to get. So I'm going to look at that this week as well. Hopefully, sort that for you. But I really do think now we're nearly at the end of this. It's been a bit of a struggle, as you're all aware. And again, I just want to highlight my thanks that you've actually stuck through it. The guys who have been with us in partnership and gone through that transition. It's not been good for anyone. It was tough, but now now you're all writing business properly in New Distribution. Especially this is really to the IFAs on here today. Really thank you for your loyalty, because none of you left, and that's really an amazing test of your character to stay with us over that period. And you could have easily taken the easy road and left, and that might have been the best option or easiest option at the time. But now staying with us, hopefully you'll bear the fruits of that decision. So going on from that, so that's good news. I'm almost done with that. So if you want an update on where we are, a bit more specifics, then give me a call or give me an email, and I'll let you know. I also want to say congratulations to Anthony Pollard. He's not online this morning, but he got his first GI sale. So it kicked off his new year, and it's his first bit of business ever written. So that came through a couple of weeks ago, and I noticed that. I thought I'd just highlight that as well. So well done to Anthony. He lives up in Lake District, and yeah, hopefully that's the start of a good spread of business for him. And then we've also got Nicola Groves, who's a new lady who joined us in December, and she has got her first mortgage client to see tonight. So again, I want to wish her good luck for that meeting that Chris Nairn will be attending with her. I want to give you a quick reminder for an event that's coming up in a couple of weeks' time. We've got a masterclass event in Southend. We are hiring out a room in the Park Inn Palace Hotel, which is opposite our main office. It's called the Springboard to Success, and it is hosted by Mark Hobbs, and it's all about kicking off your new year and kicking off your business in the right frame of mind. And his motto, his tagline for this event is "There are no such thing as there's no such thing as sales skills." So I think he's going to throw away all the books, all the management information that you learn in these textbooks and all this, and he's going to start and say, you know what, it's not about that. It's all about what you like, your attitude, your ability to see things through, and the way you behave with clients, and the way you are, and the way you know your products, and that's what's going to help you sell. So he's going to kick off the new year, the Springboard to Success program, which is on the 27th of January in the Park Inn Palace. I believe it's a 12 o'clock midday start, but if you get there from 11 a.m, there's going to be coffees and teas and so on, and there's also going to be lunch provided to you as well. I think we've got about 25 to 30 people coming down to this event now, so it's really well supported. So I'm guessing a lot of you here know about that already, which is good. But if you don't, get in touch with Sarah at the office, and she'll book you in, no problems. And finally, before I do hand over to Kieran today, I just want to give you a quick reminder. We've got the audit, the advisor audit is coming up at the beginning of February. So me, Kim, and Mark and Kim will be looking at the IFAs as well. Make sure that you have all your CPD logged properly. Make sure that if you've got any file checks that need rectifications, that is sorted. And make sure your business is submitted properly and so on, because we're going to be checking all these things and looking at KPIs, looking at your CPD. So we want to make sure you pass the audit properly and help you get to that competent advisor status if you're not already there, and also of course to maintain your competent advisor status if you are already there. So that's coming up in the beginning of February, and we're going to be looking at all of the IFAs we looked at, and we're going to be looking at, for the mortgage and protection advisors, we're going to look at the alphabetical order, first names from A to L. So if your first name starts with an A or start up to an L, then you'll be checked in the beginning of February. Okay, right. So that's all the news from me. What I'm going to do now is I'm going to bring in Kieran. So let's see if we can hear him. Okay, Kieran, are you there?
Hello, Daniel. Yeah, I'm here.
Brilliant. Hi, Kieran.
Hello.
So thanks for coming on, and good morning to you, sir. I'm now ready to make you the presenter. Here we go.
Thank you very much.
Okay, over to you, Kieran.
Right, let's just make sure the technology works. Can everyone see the screen?
Yep, we can see it. All good.
Yeah. Right, I'm going to take you through certain markets, how we see the world today, a bit about how we saw the world last year, some of the decisions we made last year, and there's certain themes that are certainly going to come through. Now, I know some of you are involved in mortgage markets, so I'm going to talk a bit about fixed income and the future for that, and basically where we're going. So I think we'll have a bit of time at the end of this for some questions, because I like questions from everyone, so that'll be good. Right, so this is what I'm going to cover, the economic update, and I'm going to go sort of around the world, but I'm going to concentrate more on, obviously, the UK, because most of us live in the UK, and also the outlook for property, commodities, and what we think are the big issues of 2015. And there are certain issues that are going to be major topics, and we actually think the world's going to be quite a good place in 2015, but it's like everywhere, there's always going to be a few hurdles, and you know, that's already started since we've been in this year. So I'm going to have a quick look at last year and about consensus, because I think consensus is always interesting. There's a big conference in London about the second week of January called the New Model Advisor Conference, and there's about 250 IFAs attend, and we were there last year. And one of the things we did, we asked everyone what they thought, and it was interesting. You know, it's New Year, everyone's very, very bullish on equities. Absolutely everybody thought interest rates would go up in 2014. Everyone thought the US couldn't have another stellar year and would slow down. Everyone thought that government gilts would lose you money, which proved to be totally wrong, and everyone thought that property was only going to go one way, which was up. So just going over that, equities did have a good year, but some people had a much better year than others. Not all equities made you money, and some didn't. Interest didn't go up, and we don't think they'll go up now till certainly after the election, but we'll talk about it a bit later, because we think there'll probably be 2 elections this year, not 1. The US certainly doesn't look like slowing down, and in fact some of the data that's just come out this morning, even though jobs data's down, we still think the US is probably the one safe haven to make money. Gilts is an interesting one. Gilts made you anything around 10 to 15%, and sort of long gilts made you more than short gilts. And when I say long gilts, they're gilts that have more than 10 years to run. Medium gilts are around about 10 years, so the long gilts are 10 to 15 years. The others are about 7 to 8, and then short gilts. But everyone made money in gilts. And as we know, property put in quite a stellar performance. Whichever index, and there's quite a lot of indexes out there, and some are better than others. But if you look to the IPD index, you'd have made over 10%. So our thoughts for this year, and one of the things I want to make is that everyone seems to, when you talk to people, they try to put you in 2 camps. It's either, you can probably tell something about my age here by picking out Harry Enfield when he looks quite young, plasterer from Essex, the loads of money type situation is, depending on what people are trying to sell you, they either go over the board, where they try to over-egg it, and make sure, yeah, this is a fantastic opportunity, you can't miss this can only go one way. Or you tend to get the Fraser from Dad's Army type view of the world, which is we're all doomed no matter what's going on. And consensus tends to be, or what actually tends to happen is there's somewhere in the middle. Some things are bad, some things are good, but overall there's always a consensus. So where do we go from here? Right, everyone has a forecast for coming years, and there are literally hundreds of these. I picked out one. This is issued by Forbes magazine. Personally, I agree with some of it and I don't agree with some of it, and I think every forecast I ever see, there are bits I agree with, bits I don't. But one of the points I think you want to take from just about every forecast you're seeing at the moment is, if you notice, all the numbers on this screen are positive. Okay, and some more positive than others. Now, the one that strikes me is Asia and Australia, ex-Japan, up 5.7. Well, I don't think Australia will certainly make 5.7. I think it'll be nowhere near it. I think certain parts of Asia will, because in this particular forecast, they're adding China, and China's still growing at 7%. But the main takeaway from this is, even if you look at Western Europe at 1.4, which it might or might not do, they're all positive. And I think the view of the world at the moment is predominantly pretty positive. Now, these are forecasts, and when I say that, it means in a year's time they'll probably near enough 100% be wrong, but overall they'll sort of, in a way, sort of be right as well. I'm not going to go over this. This is for yourselves to look at another time, because I'm sure Daniel will be sending you these slides. And this highlights some good points and bad points, but this is just another forecast. Right, let's move on to the UK economy, because I think this is what everyone's really interested in. The pros of the UK economy is we have growth, and we're doing quite well. So from that perspective, we're doing very, very well if you look at especially Europe. Interest rates are still historically low, and we think will stay historically low until after this election. Now, I'm going to talk a bit about the election, because that's the thing that really does going to drive the UK this year. And consensus now is there's going to be 2 elections. There'll be a first election, where somebody will have, obviously he's going to win and have a majority, but either won't be able to form a government, or might go it alone, or that first coalition could fail quite quickly. And certainly when you start reading what both the Labour Party and the Tories are doing at the moment, both are planning for 2 elections this year. So you're going to have a first election, followed by a collapse of that government, and followed by a second election where you will see one overall winner. Now, that has quite a big impact on interest rates, because the man that sits in the middle is Mark Carney, we all know, who's the chairman of the Bank of England, and Mark Carney is probably not going to do anything until that second election. Now, the reason we think that is politically putting up interest rates before the election would be seen as a political move, and therefore he's probably not going to do it. The second reason he's probably not going to do it is, at the moment, there is absolutely no reason to put up interest rates. And for those of you in the mortgage market, one of the things Mark Carney has done in the UK, which he did very successfully in Canada, is by revising the mortgage market, by making it harder for people to get credit, he actually takes credit out of the system, therefore puts less pressure on interest rates. Also, putting up interest rates could start people who are covered in debt. As we know, debt's a big issue in the UK as it is everywhere else in the world at the moment. So that's seen as a political move. So currency, sterling, is stable and strong. The mere fact we're not part of the euro at this particular moment in time is, when I talk about Europe, is quite a big factor, and we think that is particularly good. And consumer spending is happening, and it's happening strongly, and that's good because to keep a recovery situation going, you need the consumer to spend. Now, the cons of everything at the moment are obviously election. The thing that springs off the election, if we do get a Tory government, is EU membership, which certainly that's in a recent survey of business leaders in the UK, that's a big problem for them. This is not a political statement, this has to be a fact. Government spending, that's going to be a big issue post-election for either party, because Mr Miliband obviously wants to spend more, Mr Cameron wants to spend less, and it's quite interesting, everyone's saying let's spend less, but actually we're all spending more, and that needs to be dealt with at some stage. And the first words you see there, inflation, I think we all know, which is when things go up in value continuously, and you'll have your own views about inflation depending on where you live in the country. And the second thing is deflation, which for those of you that watch the news is suddenly starting to become an issue in Europe. And the problem with that for us in the UK is deflation, because they're our biggest trading partner, deflation could be transported from Europe into the UK. Now, the good news about deflation is if we get deflation or even not particularly high inflation, what it actually means is interest rates won't go up. So for fixed income investors, we still think 2015 will be very, very good. We are expecting, though, in equity markets, a lot of volatility to the election and probably after the election. So even though we think equity markets are good, there's volatility even this morning in the pre-trading of the FTSE 100 already. So we're expecting that volatility to certainly carry on post the election. So, but the UK, we think, is a good place for investors this year. US economy, I'll spin, I'm quickly on the time. Yeah, US economy is getting a big trading partner in the UK. Really the bright spot in the whole world. Main reasons are, as you can see, Mr Obama, he's in his second period of term now, so he can't sit for a third term, and he's got 2 years to run, which means he can quite frankly do whatever he likes because he hasn't got to sit and be re-elected, and he hasn't got to face any real elections this year. The US economy, as you can see from the graph, is growing the fastest in the world, and they've got real momentum just across the board in just about everything. If it's jobs, all the way through to credit. I mean, cheap oil is having a massive impact. I mean, I was watching a presentation the other day, and the sale of SUVs in the States has just gone through the roof. Why? Because people see them as being cheap now. And on the international front, the US have been quite clever. They haven't made a big thing about it. You've probably seen on the press that they've started to sort out their differences with Cuba, and they've just made a major trading agreement with China, covering off greenhouse gases. So they've had a lot of good wins, I mean, for their home investors in the States. Now, the cons are large capital stocks in the US, so S&P 500 stocks, are not cheap by historic value, historic measures. And we, as a house, we like valuation, so this is something for us to look at. Even though we like the US, they are quite expensive, but they're not at all-time highs, so there's certainly room for them to go. And the other problem they're going to have, or possibly could have, is shale oil gas, oil and gas. And the reason for that is a lot of this was funded with what's called high-yield bonds, and all they are is fixed interest securities that are raised to basically finance taking the gas out of the ground and the oil out of the ground. And of course, as we all know, the oil price has fallen. So the revenues coming in don't equal the amount they've got to pay out. So that could be a negative for them, but everyone's going to wait to see how that will play out over a sort of period. But overall, the US economy is in very, very good shape. Eurozone. Now then, we all watch the news, so we know what's going on in the Eurozone. Now, the big danger for the Eurozone, the only reason I've used one graph, is deflation. In December, they actually had their first bout of deflation. Now, deflation, for those of you that know a lot about deflation, Japan had deflation for about 20 years, and it's basically crippled the economy. And that's because consumers stopped spending. Why would you go and buy a colour TV today or a car today when it's almost definitely going to be cheaper tomorrow? So what happens is people stop spending, and to get recovery, you need to get people spending. So what they're going to try to do, possible QE, I think it's almost definitely going to happen. QE, quantitative easing, we've had it, the US have had it. It's a buyback of government debt. What it does, though, it inflates assets. And if you inflate assets, you actually drive inflation into the system. Okay, so that's pretty much going to happen now. We certainly, especially as us being a large French company, and I work for Architects as well, so we actually do everything in the whole of Western Europe. So in the building I work, literally there are about 30% of us are UK, and well, my boss is Swiss and his boss is Danish. So there are a huge amount of Europeans, and when you talk to them, this is definitely going to happen. The euro is incredibly weak and gets weaker. It seems literally by the day. So for all of us that are going to go holiday, if you're going to go skiing in France this year, or Switzerland, well, not Switzerland, but if you go, say, Germany or Austria, you're going to have a great time because the euro is weak and it's getting weaker. So they're going to have to do something about that. Now, you could say the reason that's a good pro is because if your currency's weak, it means your exports are cheaper. So, technically over a long period, you should benefit from a weak currency. The cons are Greece, again. There's an election on the 25th, and the party that everyone seems to think wins is going to try to take Greece out of the Eurozone. They want to refinance their debt. They've got a huge amount to pay back this year. They've fallen out with the Germans, and that's a big negative. I have two ways of thinking about this. I think this could be a good time for the EU to actually say goodbye to them, and the only reason they probably saved them back in the early 2010-2011 period was we had so many other problems due to the financial crisis. They had to hold the EU together. I'm not sure that's the case now. Spin-off from that is equity markets are very weak in Europe. The good news for that is if you're like us and you like valuations, which will come out a bit further on, we actually think they are ridiculously cheap. So you've got European companies are much, much cheaper than US companies that do pretty much the same thing and still have strong revenues. I'll talk a bit about Russian sanctions coming on because they're quite important. One of the reasons certainly the Germans are having a problem with exports at the moment is they export so much to Russia, and of course at the moment the Russians can't pay for them, and one of the trouble with these exports as well, they can't actually do them because of the sanctions, because obviously there was a plane shot down, as we all know, over the Ukraine, and 300 and something, I think about 340 Dutch people were killed. So the European zone brought in, along with the US, sanctions on Russia, and so did the UK. And that's had a great effect on Russia. But the problem with that is it's meant that they can't actually export. And this problem with deflation will spurn action. There is no doubt about it, because if there's one thing everybody really, really fears globally is deflation. And that's because it is like a slow erosion that takes place over a long period of time. Right, moving on to Japan, still the third biggest economy in the world, someone we have to be interested in. The picture of the man there is Abe. He's the Prime Minister. He called a snap election at the end of last year and won. The reason he won is he is trying to change everything. As I said before, one of the big troubles Japan's had over a long period of time is deflation, and he came up with a policy called the Three Arrows. And the three arrows are, as you can see there, and the first one is dispel the deflation mindset, aggressive monetary policy. What does that mean? That means QE, quantitative easing, which is basically pumping money into the economy, printing money at a level we have not seen, far beyond what we did in the UK and far beyond what the US have done. This man is serious about sorting Japan out. He called the snap election. The reason he did it was people were saying the 3 arrows weren't working. He is spending so much money. If this doesn't work, in 5 years' time, they will run out of money. They have a debt ratio now which is pretty much probably 40 to 50% higher than the UK's. So this is a major strategy. The reason he needs to do it is because of the deflation situation. He needs to get Japan back up and running, and also they have a massive aging population, and that needs to be financed and that needs to be dealt with. So, but the good news is, though, there's now total political stability in Japan. He won outright with a massive majority, which was, even though there wasn't a huge amount of people voted, the ones that did voted for him. Equity markets have been recovering, and the currency is, even though it's slightly weak, is very stable. Now, coming on to the oil price, which we'll talk a bit about later on, Japan as an oil importer, this is a real benefit for them, because if you think, if you're importing oil and it's literally halved in value, that increases your profitability globally. So that's a big positive for Japan. Right, emerging markets, and this is split into two sides, really. The oil users, i.e. India and Korea. I think I only put this slide in because I love the carry on up the Khyber slide when I would talk about India, because India's been a fantastic place last year. If you've invested in India last year, Moti won, and it's up 31%. The other big users are Korea and, as I said before, Japan. So there's lots of people benefit hugely from oil. The area has been absolutely shot to pieces, really. The currencies are all weak. Why is that good? If you've got a weak currency and you're going to expect, basically produce a plasma television and try to sell it in the US, it's got strong currency, that's a big benefit to you. And they are going through a period of global recovery. Most emerging markets have started to recover. Those that are in, and I said there's two sections here, this is two sides of a coin, they're in the oil user side rather than the oil producer side. Because on the other side you've got the oil producers. So you've got Russia, Venezuela, Iran. Now, they can't balance their budgets unless they have $100 barrel oil. In fact, Iran and Venezuela certainly need about $110 barrel oil. So at the moment they've got less than $50 a barrel. There are people even now, there's one slide I could have put in, but it's too big and it wouldn't really work, but there are people talking this could go as low as $35 a barrel. So at the moment the pressure is certainly to go down on the oil price and not up. Now, why is that so important? Well, it's two things really. The first one is there's massive overproduction of oil, and there's massive overproduction of commodities generally. So that's what's having a big impact on the oil price. There's sanctions on Russia, so therefore they can't raise US dollars in financial markets. Therefore, the only way they can finance everything is by basically selling oil at $100 a barrel and then using those dollars to buy things. Another thing that does affect the emerging markets especially is the US taking off quantitative easing. That is definitely going to happen. Yellen has made it perfectly clear QE will go down, and it's already started quite significantly, and that will also basically repatriate capital from emerging markets back to the US. So that's going to have a slight impact, and a lot of these countries are resource producers. So South Africa, if you think about it, Australia, not that that's actually an emerging market, but Brazil, places like that, a lot of Latin America, they all produce resource, and resources at the moment are cheap. I'll give you a rough idea on that. Iron ore has halved along with copper over the last 12 months. So you're basically taking a fixed cost out resource out of the ground, like iron ore, and you're having to sell it at half the price you did before. Right, commodities. Why are there problems with commodities? And the picture to the right is of China. A lot's been spoken about China, China slowing down. China will still grow at 7% this year. We actually think that's slightly overblown, the Chinese slowdown. Even though, yes, it is slowing down, which is pretty obvious when you think of anyone that's seen how fast China's grown. And for those of you that watched Skyfall on the television at the weekend, amazing pictures of Shanghai. You know, once you've built Shanghai, it does sort of basically tell you probably don't need as much iron ore as you did need before, and you certainly don't probably need as much copper. China's slowing down, but it's still growing at a much, much faster rate than just about everywhere else in the Western world. So in the global world, sorry, not the Western world, but in the global world. So China is still growing, even though there is slowing global demand, and a lot of that is fueled by, to be honest with you, China not buying so much. On the commodity side, there's a lot of pros and cons. I mean, I'm not sure maybe you would follow coffee, but coffee at the moment probably is only going one way, which is up in price, and that's because there's been problems with the crops in Brazil. Metals, we are not big fans really of metals. We probably like industrial metals more than gold. Some of you might know what this substance is, which is a little one, palladium. If you've got a catalytic converter, pardon me, that's what sits in your catalytic converter. So it's an industrial metal. It's also being used in jewellery now, which I was quite surprised. I actually, while searching for this image, did a bit of reading last night. And gold is making a comeback. Now, gold, as we know, has slid off its highs. The last few weeks, whenever you get political instability or fears in marketplaces, gold definitely always seems to make a comeback. And we think it's going to be quite a volatile year. So I would actually, one way or another, I think gold might go up. I'm not a big gold fan, to be honest with you. If it went down, it goes up. It really doesn't make a lot of difference to me. I prefer the industrial metals. And the cons of commodities, as I've said before, is massive overproduction. One of these reasons that's happening, if you look at the big Australian companies like Rio Tinto and BHP Billiton, they are still massively overproducing iron ore, copper, and basically flooding the market. And the reason they're doing this is they're actually using this as a way of putting smaller, less financed companies and producers and mining companies out of business. So they're using this as like a political weapon. Oil is pretty much the same. The problem you have with oil is the Iranians, the Russians and the Venezuelans need to keep pumping oil basically because they need the revenue. On the other side, in the past, what's happened is the Saudis, whenever these situations happen, cut production. The Saudis this time have decided they're not going to cut production, and so there is a massive glut of oil. So that's what's driving down the oil price. That will change when two things happen. One is somebody decides to cut production, or two, demand starts to go up at a significant rate. Personally, we don't think demand's going to go up at a significant rate. Therefore, it's got to be somebody's going to have to cut production at some stage. But at the moment, on commodities, we are, as you can probably guess from what I'm saying, we're not particularly big balls on commodities because even though, you know, we don't think, even though global demand is slowing and the globe is getting better, to get back to some of the levels that they're producing this amount of oil and copper and gold at is pretty much unsustainable in our opinion. Right, property. So quite a lot of you involved in property, and what do we think about property? I could have put a picture of a building on here, which I decided not to. Britain's fragile housing market, property bubble, blah, 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 money weak. This is probably the one asset class most people get wrong continuously, so I'm putting myself pretty much in that camp. Luckily, I bought my house quite a while ago, and I didn't move and I didn't sell it, and in 2008, I stuck with it, and it's proved to be a very, very good asset. Right, why do we like property? Well, the first thing is the yield, i.e. the income it produces, is much better than fixed interest. Fixed interest markets, as I said previously, are going to come under pressure when inflation starts to happen and go up, whereas property is a real asset. So as a real asset, you do have capital protection as well as yield protection. So that's obviously a big benefit to it. You also, as we all know, anyone that's ever owned a house, is you get inflation against protection against inflation. So if you think there is going to be more inflation coming long term out, then it's good to have real assets that give you protection. And of course, cash is at a very, very low rate of return. So cash really isn't going to make you any money in the long term. You don't get any inflation protection, and you don't get a particularly good yield at the moment. So they're the sort of benefit in property. Obviously, the cons are, as we all know, it's not very liquid. Price, London South East, everyone's going to have the same views on that, and the second one's demand. We think on the demand side of it, and the more commercial property companies we talk to, a lot of them are starting to look more outside London South East. Why? Because, to be honest with you, warehousing, property's cheaper, they can get a better yield, and as the country recovers, there's more demand for warehousing and storing, and people are going to move further and further out because prices in London are at all-time highs. We don't think prices in London in the South East should really be reflected in these type of presentations because people buy premium assets in London. I mean, I actually work in London every day, so I go to work, I see it. And for those of you that watched the television last week of the Russians coming to London, one of the things that was pretty clear was there's more of them coming, and they've all got big checkbooks, and they're certainly going to buy more. And I don't see why we just focus on them, because I work for a French company, and London at the moment is absolutely teeming full of French people as well. It's a global capital, and it will continue to do so. We actually like property in 2010. One of the main, in 2015, and one of the main reasons for that is we think it's better than fixed interest. And we don't think you'll see as stellar like double-digit returns as you saw last year, but we certainly think you'll see good returns. And we don't think demand is going to come off that much because we think the UK economy at the end of this year will be in a good place. Right, real issues 2015 are deflation, inflation. That will affect interest rates. The little "this is money" which comes out of the mail, the difference between the blue line and the red line is the Bank of England's predictions actually of increases in interest rates, and as you can see they've gone down. If we took this back about 4 years, they've gone down just about every time. We think Mark Carney is much more a man about controlling credit than putting up interest rates. He knows putting up interest rates could affect a lot of borrowers, a lot of people that are heavily over-debted. So we think he'll stop trying to do that, and what he'll try to stop you actually getting the money to start with. And you've seen that in anyone, and I know some of you guys are involved in the mortgage market. You've seen that more than anyone, the control of credit. Russian sanctions, as I said, we've now got oil at $50 or less a barrel. The Russians will probably have to start negotiating now. Putin is at an all-time high in Russia. We're talking about things going on in Ukraine. Ukraine is less than 1% of global GDP, so in itself not particularly that interesting. But he'll have to do something about sanctions now. The oil price, that's going to dictate the number one, deflation or inflation. If the oil price starts to move back up, we'll probably come out of deflation, go a bit into inflation. If the oil price stays where it is, we'll have a deflationary environment. Anyway, we don't think interest rates are going to be going up anytime soon in the UK. If at the end of the year they were, up by a quarter or even a half, that's probably where we would think, and there are two boundaries. 1/4 is where we think, and half maximum. We don't think Mark Carney is in any hurry, and we don't think whoever wins the election is going to be in any hurry to put up interest rates. Global growth, we think global growth is good. We think it will continue to move in a great upwardly movement. Some places will certainly do a lot better than others, and you can bet your bottom dollar most consensuses will be wrong. The negatives we see from the UK election is equals EU membership. How that plays out, only all of us will find out nearer the time. The little graph at the bottom is from Gazprom, which is to do with Russia, which is interesting, which is it's appeared on the Gazprom website actually, which basically says, we produce oil and gas, we sell it to the West, and they pay us a lot of money, and it comes back, and that's what fuels the Russian economy. It's quite interesting because the Russians actually had to bail out the Gazprom private bank the other day to a massive tune in dollars, because that cycle's now been broken. And the sooner the situation with the Russians gets sorted out positively, that takes a big negative off all of us, to be honest with you, because there could be political instability if the Russians start feeling the pain. And I've got a few friends that regularly go to Russia, and already things aren't on the supermarket shelves and you can't buy certain things, and companies are actually refusing to sell things into Russia now. So that's a big issue, but again, as I said, the main thing is most things are pretty positive. Our positions are, we like the US. Why? Because we think it will, it's the strongest economy in the world and continue to grow. Asia, and when I say Asia, we're talking about the the China type region. We still think that will continue to grow. And Europe, the reason we like Europe is because we think it's ridiculously cheap. We can buy great companies at less price that do exactly the same things as quality US companies. So that's one of the reasons we like Europe. We're neutral on Japan. Half of us agree that RB's 3 hours of work and the other don't. We think it will be the currency, so we don't want to be underweight, so we see in the middle. Fixed interest, we're neutral on. Why? Because we're probably more pro-property. And of course, the trouble with fixed interest is it's going to be affected by inflation or deflation. But we think fixed interest will serve your customers well this year. The thing is, at the rates we are at, it does show little value at the moment. It's pretty much fully valued, but saying that, you need defensive assets in any portfolio, so fixed interest will stay there. Underweight the UK, I would put a caveat on that, certainly to after the election we know what's going on. And that's because we think there'll be quite a lot of volatility coming up to the election. And we don't really want to experience that. We don't think our customers do. So we're going to be slightly underweight. And we're still underweight emerging markets. And the reason we're underweight emerging markets, to be honest with you, is that we're only really investing in what we think are oil-positive importers rather than oil or commodity producers. So that's the sort of two sides of it. And at the moment, as I said on the bottom there, we don't hold any commodity funds. We hold property to the maximum of, we have a model, because it isn't a liquid asset, so we have a model of 10%, and at the moment we're just about on 10%. So that's where we sit. We're not going to really change those opinions in the short term, and we think that, this year's probably going to be very, very good, but it probably might be, to use the sporting analogy, a game of two halves. Obviously, we've got the election in the first half of the year, and then we'll see everything else happen in the second half of the year. So, nobody wants to be particularly overexposed, and especially as, your investors, our investors, have all probably had a pretty good 2014. So we don't want to risk those profits they've made. But then saying that, we still think this year will be a very positive outlook for 2015. So, of all the things I've said, I've tried to caveat the goods and the bads, but overall, we think things are pretty good. And that's where we stand, really. So, I haven't looked at the little thing over here. See if we have any questions.
Hi, Kieran.
Does anyone want to ask any questions?
Yeah, hi, Kieran. Dan here again.
Yeah, hi, Dan.
Okay, yeah, I've got a couple of questions for you.
Yeah.
So one thing we're not really looked at is regulation and any regulatory risk you see emerging this year at all from the FCA or other regulators.
Right. We think there is going to be the big thing we think is going to happen on the regulatory side is for those of you. I mean, I'm a fellow of the PFS, so I go along to the FPS meetings as though most of you do. We think the issue about cost and suitability and the cost of actually funds and how funds are disclosed at point of sale will become a much bigger issue this year. As you know, at the moment, most retail funds are get a cost figure which is based on what's called an OCF, which took over from TER. We're actually expecting a new form of OCF because there are problems with the way OCF is calculated. So we think the regulator will take action there. We're totally agnostic on it, to be honest with you. As far as we're concerned, we'll comply with whatever the regulator says. On the cost and suitability side, though, we do think there are people that are not disclosing their full costs. And I think there'll be a lot of regulation about some providers on that front. And certain DFM type propositions we think could come under a lot of scrutiny this year. So that's where we think the main regulatory things will be this year.
Okay, that's good. That's good. And the other question I have as well is to do. I know you're not involved in the pension side, but I just wondered if you can to link it in with your investment side of things. Do you think that new pension legislation will have an impact on the way people invest going forward?
Right. The answer to that is an outstanding yes. We think it's going to have two main impacts. Purely, even though I know people can do it now, the mere fact it's been so highly publicised in the press and television, we think there'll be a huge amount of people, especially in quite small pension pots, will take their tax-free cash as soon as they can post the new rules. That we think is going to have a big impact in retail property, purely because we think the buy-lets market will be fueled by that. So where everyone's saying retail property is going to go down, we actually think the opposite way around, because we think there's going to be a massive injection of capital into that market, because you're going to get a lot of people that are disillusioned with pensions, if you like, will see it as an opportunity to get into buy-to-let and that side. So we think that'll be fueled from there. We also think what's going to happen, though, is as soon as people actually do take their tax-free cash, the next thing they'll have to do is, we don't think many people buy annuities. So one of the dangers we see is that they'll do two things. They'll either put it in cash, which we obviously hope they don't do, and what we hope they do, or we think they might do, is they might buy more low-risk type income-generating investments, i.e. fixed interest. So we think that could supply a lot of support to the fixed interest markets in 2015. So you'll see money coming out of diversified, managed type solutions and going into, retail property and into fixed interest. I mean, one of the things I think for everyone on the line is we do have to try to make sure, because a 60-year-old has a good chance of living 30 years, of keeping some money in equity markets. Otherwise, the danger of them not getting the sustainable yield to take them through to retirement is possibly a real issue. And I think you'll see fund houses launch time-type weighted funds as well. So there was a big survey by BlackRock just before Christmas. So the type of funds that will say on it, you invest in this fund and it will mature in 2020, 2025, 2035, that type of situation. So we think that could be a big issue.
That's great. Thanks.
Hello, Daniel.
Good answer there, Kieran. Thank you. And then we've got a question in as well from Jeff Callahan here. He asks, going back to the oil side, he's talking about shale gas and how that's increasing, and will shale gas also put more pressure on the oil companies and maybe put them out of business in the future? What's your view on that?
Right. Okay, shale gas, good one. And a lot of shale gas development in the States has been financed by companies issuing what are called high-yield bonds. And what they are is they're a fixed interest security that pays a high rate of return. Okay, so that's how it's been funded. Now, most shale gas companies need oil prices at north of $75 a barrel. Okay, so where we are now, they have an interest rate they have to pay on their high-yield bonds, which is above what their revenue is, and this could be quite a big negative for some of these companies going forward. It has affected the big oil companies already, shale gas, there's no doubt about it, and it's affected the world oil price, because what you've actually had an increase of supply, and that increase of supply is now manifesting itself in a massive oversupply, which is what's driving down the price of oil. The big thing from the Americans' perspective is it's made them totally independent now of, Middle Eastern oil. So from that perspective, it's already having that impact. And you can see it in the share prices. I mean, I think Shell's down 6% in 2 weeks and BP's down about 14%. So it's already having a massive impact. And shale is not going away, and shale will only increase. So again, we think that's going to have pressure on commodity funds, and it'll have, so you're going to have major economic pressure on certain countries, without a doubt.
Okay.
Did that answer the question, or?
Yeah. I think that does. That's it. So I haven't got any more questions in here for you. But I think that's a good time to stop anyway, because we're nearly at the end. Thank you very much, Kieran, for your time today.
Yep.
Absolutely excellent, excellent presentation actually. So a really good way to kick off the year as well for us too. So that's quite a good thing to have on today, which is your presentation regarding the future and what's in store for us. So thanks a lot, and I'm sure we'll be in touch shortly afterwards. So a bit of feedback with you as well. Okay.
Okay. Thanks.
Okay, everyone. Just before we finish, I just want to quickly update you with the race for Chairman's Dinner. So just to remind you exactly what that is about, it's our board meeting for advisors. The qualifying period to qualify for the board is from the beginning of October 2014 to the end of March 2015. We're giving away 9 places. Top 5 advisors will be invited. A representative from the top business will be invited, one of the top will writers, and also we're giving away 2 wildcard spots for people who didn't qualify through the above. So let me just give you an update on who at the moment will be on course for a spot at the Chairman's Dinner then. Well, the top 5 brokers, in 5th place, the 5th spot at the moment is Jonathan Treliving, approximately banked 21,000 since October last year. So he's doing well. He was leading the race for a short while, for the first couple of months, and now he's dropped slightly. So maybe he'll need to pick up where he left off. I know he had a bit of a holiday over Christmas, so hopefully he'll start turning it on again. Because Nadia in 4th place is currently 7,000 ahead of him, so she's got a bit of a buffer zone there, and she's banked just over 28,000. So Nadia in 4th. We've then got in 3rd place currently Donna War, and she's just ahead of Nadia with 28,500. So in the 3rd place there. Then we've got Steve Cole, 31,500 in 2nd place, and that leaves Elliot Cohn in 1st place, who's banked just over 32,000 since October. So really strong from those 5 there. We've also got just outside the top 5, just to let you know who's close to breaking in. Dan Maddox on 20,000, so he's just outside. Rob White's on 19.5, and then Craig Jardine is on 19,000. So really close, not a lot in it, and definitely scope for them guys to get in the top 5 whilst we have another 3 months to go. So we're halfway through now the race. Top wheel rider so far, so Mike Pugh's now is taking the lead from John Graham with 67 cases, so he's now got the spot, which is really good, and of course we've got our 2 wildcards as well. And that just leaves me to say thank you for attending again on another great edition of Wake Up to Sales. Thank you to Kieran from AXA and from Marty Tass for talking to us today as well about the economic outlook and investment outlook as well. And thanks everyone who's come online. So have a great week. I look forward to speaking to you during the week or interacting with you. And don't forget Thursday morning 9 a.m. for Investment Trust Part 3 of CPD with John Band, and also 27th of January the Springboard to Success programme. If you haven't booked in, then please do so. Okay, have a good day. Have a good week.